Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at D-Wave Quantum.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. For a company that's, right on the cutting edge of frontier tech, the core story here is, well, it's not just theory anymore.
Right.
It's all about accelerating commercial traction, and that's happening even though the company is pre-profitable. That's a vital distinction in the whole quantum space.
That's the pivot point, isn't it? Moving from just pure R&D to, something commercially viable. So what are the fundamentals? What are the numbers actually telling us about that uptake?
The numbers are absolutely starting to support that commercial idea.
Mm.
If you look at Q3 2025 revenue, it was $3.7 million. Now, that represents a fantastic 100% year-over-year increase just for the quarter. But the first 9 months of 2025, that really tells the story.
And what's that?
Revenue hit $21.8 million. That is a 235% jump from the year before. So this isn't just steady growth. I mean, this is hyper growth.
Okay, so let's unpack this. The revenue growth is explosive. But I'm looking at the earnings, and I see this huge gap net loss figure. $140 million in Q3. That number sounds, well, it sounds alarming. How do we reconcile that big number with the growth you're talking about?
That is a critical piece of context, and you have to avoid getting distracted by that gap headline.
The accounting rules.
Exactly. The $140 million net loss was heavily skewed by non-cash items. Specifically, it was a paper loss from something called warrant liability remeasurement. It's an accounting thing, not an operational cost.
So what's the number that actually matters? What should we be looking at?
The operational reality is much different. If you look at the adjusted net loss, which is, the far more meaningful metric for what they're actually spending.
The real number.
The real number, yeah. It was much closer to $18.1 million. They're still burning cash, of course, but that's what you expect for a company in this phase, right?
They're investing.
Yeah.
Capturing the market.
Yeah.
That makes sense. So that brings us to their competitive edge then. I mean, quantum computing, it feels like this race for a perfect machine that's still years away. What sets D-Wave apart from the other players? Like IonQ or Rigetti.
What's fascinating here is their positioning. They call it commercial quantum now.
Okay.
They made a strategic choice not to wait for that perfect, fully fault-tolerant computer that everyone agrees is probably 5 to 10 years out. Instead, they leveraged their own proprietary annealing quantum computing tech.
Annealing.
Yeah.
For listeners who aren't familiar, what does that actually let them do today that the others can't?
So think of what Google and others are building, that it's gate model computing. It's like a universal computer meant to solve any problem eventually, but it needs to be extremely stable, which is really, really hard.
Yeah.
Annealing is different. It's purpose-built, for one thing. Optimization problems, it works by finding the lowest energy state, which, well, that translates directly into solving real-world challenges.
Like what?
Like optimizing a supply chain, scheduling delivery fleets, improving manufacturing processes, things that businesses need to solve right now.
So they're monetizing quantum today by focusing on a specific type of problem.
Exactly. And that advantage translates directly into an ecosystem lock-in. It's their moat. They already have over 100 organizations engaged on their Leap Cloud platform, and customer integrations with, say, Skywater or Japan Tobacco. Those create super high switching costs.
So once a business builds a process around D-Wave, it's hard to leave.
It's very hard to leave. You're essentially locked into their tech for that specific use case.
That makes that revenue growth feel a lot more durable. Okay, so the story is clear, but that kind of growth needs fuel. Let's talk about the balance sheet. Are we looking at constant share dilution here?
It's not in the immediate term, which is a massive relief for investors. They reported a record cash balance. Get this. $836.2 million as of September 30th, 2025.
Wow.
That's up over 2,700% from the year before. That huge cash cushion gives them a very, very long runway.
Let me play devil's advocate for a second. Is having over $800 million in cash, isn't that almost too much for a company this size? Could that be a sign of, poor capital allocation?
That's a fair challenge. Management's answer, and the CFO confirmed this, is that the cash is being strategically reinvested.
Into what?
directly into accelerating R&D for their next-gen system, the Advantage 2, and funding major customer contracts. It's capital they're holding for strategic deployment, so they don't have to rush to raise more equity. They've basically bought themselves years of development time.
That strong financial footing is reassuring. And it seems to be reflected in the market. We've seen some pretty impressive momentum in the stock price recently.
The technical picture is very constructive, yes. The stock has posted a massive 267% year-to-date return.
Huge.
And we even saw a sharp move, a 16% rally, just recently in December after they announced they'd be at CES 2026. Trading above key moving averages just confirms it's in an accumulation phase.
So the price action is constructive. Where are the institutional analysts seeing this going? Is Wall Street buying into this story?
Absolutely. The institutional confidence is really building. We've seen a whole cluster of recent upgrades. Jefferies, for instance, they initiated coverage with a price target of $45.
35, okay.
And they specifically cited ecosystem tailwinds and excitement for that Advantage 2 product. Then Wedbush followed suit, setting a $35 target. This shows the big research teams are starting to validate the whole commercial now thesis.
And what about the long-term view? What's the consensus on growth?
Analysts are forecasting a huge 73% compound annual growth rate, or CAGR, in revenue through 2030.
73%.
Yeah. A 73% CAGR suggests that the smart money sees this not as a short-term trade, but as a long-term compounder, assuming quantum adoption keeps accelerating.
That is a really compelling bull case. But as we always stress, no investment, especially in frontier tech, is without some serious risk. Let's shift gears and look at the bear case.
Right. The two big risks here are execution and valuation. On execution, the reality is, while the growth percentage is high, the actual quarterly revenue is still small, $3.7 million. So the core challenge for them is converting those 100-plus organizations from pilot projects, which are often cheap or free, into durable, large-scale paid deployments.
Right, what we call pilot purgatory. If customers just stall at the proof of concept stage, then that whole growth story, that CAGR, it falls apart.
Precisely. And we also have to talk about the volatility. We saw recent slides of 8 to almost 10% during holiday trading. And of course, the optics around insider sales. The CEO and CFO sold a lot of shares, which always makes people nervous.
That's a major point. Over 1 million shares were sold by insiders, worth around $66 million in just 3 months. How should you interpret that? Does that signal a lack of conviction?
Context is absolutely vital here. What we know is that these weren't just, opportunistic sales. They were pre-scheduled under what's called a Rule 10b5-1 plan. So executives set these up way in advance to diversify their holdings. When a stock is hitting new highs like this one was, those pre-scheduled sales often get triggered. The market generally sees that as noise, not a warning sign.
That helps, but it doesn't change the operational reality. That $18 million adjusted loss.
Yeah.
It still suggests they have significant overhead. What's the path to profitability look like?
It means the path is delayed. They have to keep up that aggressive R&D spend. But there is a very positive metric here. They have incredible 84.8% gross margins on their system sales.
That's phenomenal.
It is. It shows the value of their IP. The challenge is just that the operational loss, adjusted EBITDA loss, was $20.6 million.
Yeah.
It means they have to keep ramping sales to cover those fixed costs. The leverage is there. They just need to scale up.
So for anyone tracking this, what are the near-term catalysts? What are the big events on the calendar we should be watching?
We have two massive visibility events in Q1 2026. First is the CES 2026 Foundry Participation in January. They'll be presenting a masterclass and showcasing their hybrid solvers, and crucially, featuring real-world customer success stories.
So providing that concrete proof of traction.
Exactly. That's key. And what's the second event? Second is the QBTS 2026 User Conference, also in the first quarter. This is historically a huge platform for them to announce new customer wins and provide roadmap updates. It's a chance to see that conversion rate in action.
And then, of course, earnings. Q4 2025 earnings are expected late January or early March 2026. That report will be absolutely critical, right? Not just for the revenue number, but for their forward guidance.
For sure. The guidance on Advantage 2 and their commentary on the customer pipeline, that's where you get the clearest view. And one more thing to watch.
What's that?
They're forming a new business unit focused on U.S. government needs. That's a really smart move. Any contract wins in that federal space in Q1 or Q2 would be a huge material catalyst.
This is a fascinating story. You have a company with real commercial traction, incredible growth rates, a massive cash cushion. but it's still navigating that path from small pilots to sustained profitability.
If you are watching this company, the next few months, especially leading into CES and the Q4 earnings, are going to provide vital clarity on their ability to convert that quantum now advantage into something long-term.
And the question you have to ask yourself is D-Wave's annealing approach a defensible long-term moat? Or is it just a temporary head start before those massively funded fault-tolerant machines finally arrive?
We encourage you to keep learning and keep challenging the assumptions behind your investments. And always, always focus on operational metrics over the gap accounting noise, especially in high-growth tech. Don't forget to subscribe to Smart Wealth with Joshua for your next dose of expert stock analysis.